team. I hope they would basically be able to pick it up from there. And we have one main speaker, Hosakote Akshay Shrinivas. Uma will introduce in detail. And Mr. Sunil Kumar is the founder and the director of WinNest, and he has been kind enough to organize this knowledge web series session for us to educate on finance and taxation. So, with no due time, over to you, Mr. Sunil. Thank you very much.
Yeah, thanks a lot, Riaz, for welcoming us to provide a webinar session for your, for your fellow members over there and staying in Germany. Okay, Ellarigu Namaskara. Okay, and to introduce myself is Uma Devi here, helping people to plan financial needs. Okay, and so I would like to introduce Mr. Sunil Kumar here. He's the managing director of WinNest, a dynamic money developer with 20 plus years in personal finance, a certified financial planner with an AUM in hundreds of crores and over 33,000 clients over the globe. Okay, just please. Aiming for 50,000 crores AUM by 2031, a founder and a director of Siridharini Eco Habitat and a renowned SIP booster, a public speaker on a financial awareness featured on Doordarshan and Chandana TV. Active in social causes like old age homes, children homes, and rural programs. A strategic financial planner with a large and a growing client base. A key attributes: adaptable, flexible, and a reliable and a strong conversationalist, a grateful and a socially responsible, dedicated to giving back to the society. He holds an experience 8 plus years in direct marketing and a boutique wealth management of 18 plus years. Okay, with this, I request everyone in the chat box to welcome Mr. Sunil Kumar by typing down welcome, Mr. Welcome. Okay, I request everyone to type down welcome in the chat box. That would be a great welcome to Mr. Sunil Kumar.
Thank you, Uma. Over to once again back to you. Yeah, for the second introduction. Yeah.
Yes. So we have one more speaker, Mr. Akshay. Just Mr. Akshay. Hope you can come on.
Yeah. Hi. Good afternoon. Good morning.
Yes. Okay, so just to introduce Mr. Akshay representing Akshay and Associates, basically a chartered accountant. We are into tax and advisory services for our residents and NRIs, a corporate and a non-corporate compliances consulting services from 2019. Okay, a one-stop solutions for tax planning, advisory, and filing services across India. He would be and any services you can, we'll be sharing his contact number. You can also do that. And now, right now, he'll be going ahead with the introduction. Mr. Akshay, yeah.
Thank you, Uma, for your kind introduction. So it's been great. So good morning to all who are attending this thing. I don't know. It's good morning over there. So I'm representing Akshay Associates. So it's basically a chartered accountant firm based out of Bangalore. South of Bangalore. So we are two partners, me and my brother. So we both are catering to NRI clients as well as our residential clients for tax advisories, compliances, and corporate compliances from 2019. Thank you, Sunil sir, for inviting us, and we'll be sharing an insight about the tax implications for NRI investments in India, particularly for individuals.
Thank you, Akshay. Yeah, you're right now it's 3:40, right? You are allotted exactly 20 minutes, and probably we also have to take some questions and answers. Maybe another 3-4 minutes for that. Here you go, Akshay. All the best.
Sure. So I can start sharing the screen now.
Okay. Until you set up. Dheeraj, let me have a couple of, So I was just telling, I think so the entire world right now is focused on the Trump tariff, and also the trade war happening. And yesterday, I think so, the entire globe was really concerned about what's going to happen between the Ukrainian president and the American president, and we all know what was the outcome. The European Union stood on the side of Zelensky, and he was literally very anxious about the kind of conversation which really went on, and it has been currently the news is viral that there has been it was not such a great chat between these two gentlemen, right? The entire world is absolutely furious right now. What's going to happen next? Yes, we are witnessing a lot of turbulence, right? In the last, after President, Donald Trump has been re-elected, I think so. We are facing a lot of turbulence in the global geopolitical scenario. Same thing is happening. If you look at from the Indian context, markets have been shaky. Markets have been really, from the level of 86, we are close to around 73, 74 right now. Almost we have witnessed a correction of around 15 to 17%. Now, what is this happening in India? What is this? There are three kind of scenarios for the benefit of all the participants here I would love to share. One is if the markets really correct from 0 to 10%, we call it as volatility in the market. If it is beyond 10%, we call that as a correction. If it is beyond 20%, we call that as a crash. So for the benefit of all the participants, what I would love to say is it is not a crash in India, it is a correction. So why the correction? Definitely it is the T-cube. What is this T-cube? Trump tariff and trade war. And also the foreign portfolio investors or the FIIs have also pulled out money from India to the extent of 1 lakh crore. Is it the end of the Indian growth story, or is it India right now under bear market? I will not say, because Indian consumption story is very much intact. India as amongst all the other countries in the world is right now having the biggest advantage of the manufacturing destination, the China plus one opportunity, right? And nobody can take away the youth. The 145 crore, almost 70% of the population is in the age group of 15 to 30, is the biggest strength. And with English speaking ability, adaptability, India has an edge over the entire world, although markets have corrected a little bit. In fact, markets have to correct because after COVID, markets never corrected. It's been consistent bull run, which is also not good. There has to be some sort of correction in the market, and what we are witnessing. How India, I'll say, is really Indian growth story is intact because the domestic participation in India, the DII, what we call domestic institutional investors, are pouring in money in spite of a lot of withdrawal from the foreign portfolios. In fact, I would love to give you more inputs. I think so Akshay is ready with his slides. Am I right, Akshay? Can I basically stop here?
Yes, we can start.
I will allow right now Akshay to basically share his thoughts and on the taxation, which I'm sure a lot of participants, we have around 47 participants here. Most of us are curious to know what is happening from the Indian taxation. What did Nirmala Sitharaman really came out with the budget? How is it going to help the NRIs? And a lot of questions. Akshay is the right gentleman. Over to you, Akshay. Thank you so much.
Thank you, sir, for allowing me to have a discussion with esteemed people joining us. So today we are going to discuss about the global taxation of individuals, basically from NRI perspective, and the investments and income in India for the individuals who are investing. So what are the topics that we're going to cover? Is tax residency rules under Income Tax Act. Just let me know if I'm going too fast or too slow. Just let me know. You can just pinpoint, so I can just go slow or a bit fast. I'm comfortable with that. So yeah, the topics that we're going to cover is the determination of residential status, and then we also cover with the determination of taxation for wherein example of people who don't have any residential status. They might be a citizen of certain country, but as per the local taxation rules, they might not be a resident of any of the countries which they are working. And the third topic which we're going to cover in the first of our discussion is dual residence. So I'll just go forward with the first and main coverage, that is the residential status. So before, when we take up as a firm to arrive at the taxation of individuals in India for NRI investment. The first step, what we ask our clients to submit their passports and visas. So why do we do that? To know what is the residential status of that particular assessee or the client of us for the previous financial year. So in India, there is a concept under income tax called as previous year and assessment year. Previous year is nothing but in the year in which you have completed your transactions. That may be with respect to investments in mutual funds or redemption of mutual funds or investments in properties or redemption or sale of properties. So in our case, let's say, for example, 24-25 will be the previous year or the current year. And the assessment year is in which you pay your taxes or you declare your income or you declare your file your IT returns in India. So whenever a client approaches us, Akshay, if you can help us with filing our taxes, we are an NRI from this so and so countries. So what we do tell to them, so before I start your assessment, I would like to know what is your residential status. Son, he gets confused. The client gets confused. What are you telling, Akshay? I'm a non-resident. I'm a citizen of India. So what I do is I give a small clarification or give him an insight about the residential status. So residential status is as per the Income Tax Act, and citizen status if a country or individual can be anywhere. For example, if in India, if you are born in India or if you'll be considered to be the citizen. But as soon as you are citizen of India, it need not be that you might be the resident of the India for taxation purpose. So the next question is the client asked me, Akshay, tell me, how do I determine for my tax filing what will be the residential status? So I tell him, sir, there is two conditions in India for determining whether you will be taxed as resident or you will be taxed as non-resident, which is covered under Income Tax Act 1961. Now, from 2026, there is a new income tax which has been presented and proposed in budget 2025. But we'll not go there as of now, since the applicability is postponed to 2026. So I am sticking on to the provisions and rules of 1961. Although after our bare reading, we have seen there are certain changes. Only a minor changes has been done in terms of the NRI taxation or overall taxation in 2026, wherein they have changed the sections and they have brought more clarity. But overall, the entire scenario and the understanding remains the same of the previous Income Tax Act. So yeah. Okay, so yeah, the first condition for arriving at NRI taxation when we handle for our clients is we check the residential status. So under the residential status of Income Tax Act 1961, there are two conditions. The first, where we determine whether the individual is non-resident or resident. So the first condition, what it says that, let's say we are talking about financial year 23-24 or 24-25. Let's stick to 24-25. So what we do is where we ask the client, when did you leave India for the first time in this thing? So where we count the number of days. So what the IT Act says that if you have stayed in India for less than 182 days in the financial year or in the previous year, then you can be not considered as resident. And once that is the first condition. And the second condition, what income tax says that in the previous year, let's say we are talking about 24-25, you have stayed in India for 60 days or more, or you have stayed in India and you have stayed in India for 365 days or more in the preceding 4 years. So basically, to sum it up, what I'm saying is in the condition one. Hello. Hello.
Please go ahead.
Yeah. Please go ahead. Please request everyone to go on mute, or if the host can basically control the mute and unmute for all the participants. Thank you.
Yeah, so to summarize in between, if I have left in India for less than 182 days, I will be considered as non-resident. Or if then the second condition, the Act specifically says that either of the condition has to be satisfied to be a resident or non.
Akshay, you're on. Please note you're unmuted. You're still muted.
Yeah, I think now I'm back. Hello.
Yeah, you're audible.
Yeah, so Hello.
You're audible. Go ahead.
Now it's audible, right?
Yes, you're audible.
Yeah. So basically, when we are considering the residential status, we consider two conditions: whether he is a resident or non-resident. Going back again, so we see whether he has stayed in India for 182 days or less, then he will be considered as non-resident. If the first criteria is not satisfying, then let's say if he's staying for more than 60 days, and in the previous 4 years he has stayed for more than 365 days, then the condition satisfies is to be non-resident. So if both of the conditions are not satisfying at all, then straight away we will determine him as non-resident. So what is the ideal difference between resident and non-resident is that for resident, the entire global taxation becomes a point of taxation in India. Wherever, for example, I might be earning an mutual fund gains or interest on FDs across global. Let's say for Germany, I have invested in FDs or I've invested in real estate properties. So whatever gains I am making in those countries, if I am being determined as resident in India, I will be taxed that particular income as well. Whereas for a non-resident in India, the only taxation will be the income earned or sourced in India. For example, one of the individual from Germany might have invested in Indian FDs or Indian mutual funds, and he would have redeemed those things. So that only that portion of the tax will be or income will be taxed in India. So this is very a critical part of understanding a particular individual when a case or a file comes to us to determine the starting point for determining his taxation is arriving at the residential status of the particular individual as per the Income Tax Act. Further, going with the residential status, there is a small exemption or exception which is given for in the determining the residential status of the individual. For example, I am staying in India, let's say from April 23, and I leave India before September 28 or 29, before 182 days, either for an employment outside India. Let's say I get a job opportunity in Germany, or I'm a part of a crew member of a ship. And I leave India before 182 days. In that case, I will be considered as non-resident. In that case, I will not have to fall back on the condition 2, where the Indian Act says that 60 days or more or 365 days. Automatically, I will be considered as non-resident. This particular section is only for those who is leaving India as a crew member or as an employee outside India. So I hope, is there any confusion or any clarity you required in this? Do let me know on this particular part with respect to residential status. So further, I am also covering certain FAQs, like frequently asked questions by our clients during our course of filing. So how do we arrive at the number of days in calculating the 180 days or 60 days or 365 days? A simple answer is that we calculate the day on you arrive in India and day you exit out of India. Basically, the number of days is computed based on the individual's physical presence in India during the relevant financial year. The computation involves both date of arrival as well as date of exit from India. So we take the passports and visa stamps and we calculate the number of days, and accordingly we help our clients in determining the residential status. And this particular residential status may change each year on each year. Basically, this year I might be a resident, but next year I might be non-resident. So it's not a constant, like as soon as in the one financial year I have been determined as resident, it's not that every year I'll be resident, but based on my exit and entry into India and outside India, my residential status keeps on changing. So it becomes prima facie very much important for each individual before assessing his tax. Consult a tax advisor and ask him to compute his residential status before moving forward. And the second FAQ what we have covered is, does the presence in India for less than 24 hours count towards the total stay? Yes, the Act does not basically specify that the number of hours. It's basically, even if you have stayed for half a day or just 2 hours, it will be considered as part of full day. Let's say I just land in India for 2 hours and I did my particular transaction and exited. So that 2 hours will be converted into a particular day. So it will be calculated, accumulated along with the number of days. The third, which we have covered, is should the date of arrival and departure included in the day count. Basically, we have seen during our course of practice, there are different views expressed by the ITAT, basically income tax appellate tribunals and other judgments, wherein one of the cases highlighted is that they do not consider the arrival, wherein they consider the date of exit. But it's an arbitrary, wherein each courts and each this thing and have given their own view. But as a tax advisors, as a policy, we consider both the date of arrival as well as date of exit as a part of the entire 182 days or 60 days, what we have to say, we consider that. So the another important question is, what is employment outside India and what is leaving India for employment? So employment outside India is basically of already having, before leaving India, you already have it, let's say in 23-24, you already have an employment in hand in Germany. For example, I have been staying in Germany and working in a Germany-based company. I only come here for my visit purpose. And what is leaving India for the purpose of employment? What I discussed in my previous slide, wherein I do not consider second condition for a person who is living outside India. I only consider 182 days for determining his NRI status. That's where this particular definition is important. Leaving India means he's leaving it for the first time to take up a new job outside India. Let's say I have got in the 24-25, I got a job in the month of August in a German-based company. So that's where I'll be called as I am leaving India for the purpose of the job. So that's basically two difference between employment outside India and leaving India for the purpose of employment. So who qualifies under again the same explanation? Who qualifies under explanation 1A of section 6 regarding the employment outside India? Basically, it applies to an Indian citizen who leaves India for the purpose of employment outside India. This does not explicitly require the individual to already. So basically, what I have explained in the previous slide, that itself which covers the FAQ number 5. So I've just put in a case study for respect to determination of residential status. So the case study talks about a person who is of an Indian origin, but he was born and brought up and entered his education, and he holds a citizenship in UK. So what has happened is in July 2017, he is moved to India and resides in India till then, but continues to hold his UK residential status as well as UK residential house as well as citizenship. So he's staying from July 2017 to March 2024. So in March 2024, he again decides back to go to UK for his expansion and business purpose. So he's come to us for filing his returns in 2024, and he's asking us, Akshay, I have left India again on 9th June. I've come to India on 19th June 2024 for a paperwork, and then I'm leaving India on 28th August 2024. So can you just help me in filing taxes and also let me know what is my residential status for the financial year 24-25? So what we did is we did an analysis for him. So through our analysis, what we have found out is he was staying in India for the financial year 24-25 for 60 days, which is between 19th June to 28th August. So that is around 60 days in India. Wherein this I'm talking about the condition number 2, 60 days in the current year and 365 days in the 4 years. Since he was staying in 2017 to 2024 in India itself, so in the last 4 years, he total accumulated number of days was 365 days. So with that, the condition is that the intention of the person, although it was just for a documentation purpose and his visit to India was only for a limited purpose, so he'll be treated as resident, and his global income, wherever in US and UK and other places, wherever he's earning the income, it will be taxed in India, provided we'll have to see whether he gets the tax benefit treaty or tax treaty benefits or DTAA benefits for the taxes or income which is already declared in UK, which we will cover in the next slides, coming slides. So I just wanted to ask, is there any queries or any questions to be asked for the residential status, what I have discussed now? Anyone who has it, you can just let me know, or I can move forward.
Q&A, we can do it in the end. I request you to go ahead. Another
Okay.
12 minutes, I request you to take another 12 to 13 minutes, please.
Okay. And the next resident case study, what I have taken is income-based approach. So what has happened is in the recent 2024-25 budget, our finance minister, what has told us, in case of an NRI who was investing income is or income is more than 15 lakhs, he will be treated as a resident in India. So for this, I have taken a case law. For example, Mr. B, who was in for more days, for more than 136 days in India, and I've summarized his income in 24-25. Let's say dividend income was 7 lakhs, interest from NRE bank account is 3 lakhs, and capital gains from sale of shares was around 6 lakhs. So we need to determine what would be his residential status for 24-25 based on the 15 lakh criteria. So basically, Mr. B was a citizen who's less than 182 days. So he is for non-resident. That basically is not satisfying the condition 1. So for an Indian citizen who is leaving India for employment, or a person of Indian origin visiting, the 182-day condition gets reduced to 120 days if his total income is less than 15 lakhs. So now what has happened is NRE, whatever you are investing in NRE fixed deposits, so in India that particular income gets exempted. So in the scenario which we are having, so we'll only consider dividend income and capital gain income for the purpose of determination. Since his dividend and capital gain income is less than 15 lakhs, so he will be considered as non-resident, and only his income which is accrued or received in India will only be taxed in India and not his global income. So next, what we are talking about is case study of for a nomad or with no tax residency. So I've given you a scenario wherein basically Rahul, who was an Indian citizen who was working remotely. Today, people are working from India across globes and visiting across countries to perform their active businesses or their own income sources to generate that. So he's spending in 4 months in Thailand, 3 months in Bali, 2 months in Dubai, and 3 months in Portugal. And in no country his income is or he's not been considered as a tax resident. So from the Indian point of view, what we are considering is India considers him as an NRI, since he does not cover, if he's not covering 182 days in India, and accordingly we'll have to be taxed as a non-resident. So whatever his income which is generating in India will only be taxed for that purpose, and his global income will not be taxed. So this is another criteria is stateless persons. What happens to a person resident of no country, and what is his tax status in India? Basically, a stateless person is a person who is not a tax resident of any country. Such person avoids concentrated physical. Basically, his physical presence, he takes the loophole or basically advantage of the tax residential status across the countries. So now, for example, Section 61A, which is for an Indian citizen, how do we consider him as a deemed resident? So income other than the foreign source income is 15 lakhs during that. Basically, when I'm considering his total income, like income earned in India as well as income earned in foreign, is less than 15 lakhs. So, and he is not liable to be taxed in any other country or territory, then he will be considered as resident but not ordinarily resident. So there is a concept in India for residents as well. So there is concept called as resident but ordinarily resident, for whom the entire global taxation is an impact in India. And the second concept is resident but not ordinarily resident. So what happens is in the initial slide where I discussed with you respect to the conditions of determining non-resident. So by virtue of any condition, the NRI becomes a resident for that particular year. He will be divided into two categories with further conditions, where we look into other conditions like what has been his previous stays apart from last 10 years, how he has been staying in India, and if he satisfies any of those further conditions, so he will be considered either as ROR, where global income taxation is an impact in India, or RNOR. RNOR is nothing but similar to an NRI. His global taxation will not have an impact in India, only for the income which he has derived in India will be taxed in India. So basically, I'm covering another FAQs who is considered as deemed resident. A deemed resident is an Indian citizen whose total income exceeds 15 lakhs during the financial year and who is not liable to tax in any other country due to his domicile or residency rules. What does non-liable to tax in any other country mean? Basically, I've covered these few FAQs, which I'll share you once this presentation is over. You can just have a look into it. So moving forward to other slides. What do you mean by dual resident? Resident of more than one country. What are the impact? How do I assess in which country he will be taxed, in which country he will not be taxed? So these are the few areas. Like the first area is meeting residency criteria in both the countries. A person may qualify as a tax resident if he satisfies both nations' residency status. For example, how I discussed in the first slide regarding his conditions, what has been which has been put over there, and there might be a different tax year. Why it arises dual taxation? Might be different tax year systems, wherein in India we follow financial year, whereas other countries follow calendar year. So there might be an overlapping residency periods. Citizen-based taxation, wherein in USA follows whether I am citizen of USA or a resident of USA or not, where am I staying, my entire global taxation is taxed in USA. Whereas India follows only residential-based taxation. And employment or business in multiple countries. I might have employment with different companies, or I might be working with different countries. Based on that, the dual residency or type taxation arrives or need to be considered. So how do we do a tiebreaker? Which country taxes, which country does not taxes, is where we get into it. So basically, how we do it, if a person is tax resident in two countries, for example, India and Germany, so we use DTAA tiebreaker rules to determine which country has the taxing rights. So I have given a key factors or a tiebreaker rules, like for example, where his permanent residence is, or what is his personal and economic ties, where exactly he is generating more revenue, or where he is more tied up to his business, is where second tiebreaker we use. Then where is stay more often, basically whether staying in USA more or Germany more, or is staying in India more to generate his income. If in any case, if all the three does not work, then we'll go into nationality. Where is he citizen of, and what are the DTA mutual agreements? At the last point, what we consider mutual agreement. If none of the above points are ours, then both the tax authorities, due to mutual agreements which is already in place, we rely upon to do a tiebreaker in case of dual residency. So there's again a case study which I have included, when I share this particular slide, you can go through it. So foreign taxation, the next slides cover the foreign income taxation for NRIs. So what are the topics we are covering? So we are covering foreign income taxation for NRI, compliance and tax planning for NRIs. So basically rules of taxation. So I have again divided this into 3 slides, wherein ROR, resident but not ordinarily resident, basically his entire global taxation will have an impact in India. RNOR, and non-resident. So these 3 have been categorized based on the conditions which I have discussed with you in the first slide. It has been bifurcated into it. So Indian income is taxable for all of 3, like resident, RONR, NR. Income earned abroad from businesses or professions controlled or set up from India, it is not taxable for non-resident. Basically, what it says is, if I'm having an income in US and I have been determined as non-resident in India, so the global taxation will not have an impact in India. And any other foreign income, it's only taxable for ROR, resident, and for none other than there is no other tax impact in India. So Indian income tax liability for non-resident. So I've given a breakup here. So let's say if it is a salary which a person has been earning. So salary earned and received abroad for a non-resident is not taxable in India. salary credited in Indian bank account, it creates a litigation aspect for Indian tax authorities, where they might come behind you to ask you why this particular income should not be taxed, although you are earning and received in abroad. So what our suggestion is, you keep your, because one of our clients, we faced this particular issue where he was earning in US, but he was receiving money in India in his savings account. So when the tax authority picked up his case, this was a major discussions, and which went on for 6, 7, 8 months, and we particularly resolved that particular. And this is where that's why I brought it over here. And also there is also a DTA protection short stay exemption. How you can avoid? You can avoid by staying in India for less than 183 days. So this is in terms of salary income. Then the rental income from foreign property, or foreign property is nothing but the Indian property. Wherever you are earning your rental income in India, so you will have a rental income and a standard deduction of 30%. And whoever is a tenant, he has to deduct 30% as TDS before making a payment. So one option for you is you can go for a lower TDS certificate, wherein they have mentioned the criterias and timelines before which you need to obtain. Instead of TDS being at 30%, it will come down to a lower of 2%, 3%, or 10%, based on the criterias which has been mentioned in the Income Tax Act. And also there is a DTA benefit which can be looked into, foreign tax credits. If your income in India is also getting taxed in Germany, so we can utilize the benefit of DTA and foreign tax credit, which I'll discuss what is foreign tax credit and how it can be done in the future slides. In the further slides, I'll discuss with you. So coming to the main point, capital gains on Indian properties and mutual funds. So recently in 2024, when the new government came into the power and presented the first budget, they have the two categories in capital gains in properties. One is long-term capital gain and another is short-term capital gain. So how do we determine long-term capital gain? Is basically if I am holding any shares, or if I'm holding any property in India for less than 24 months or 2 years, it is called as short-term capital gain. And if I'm holding it for more than 2 years, it is called as long-term capital gain. So earlier, if you might be knowing about Indian taxation, or if you have any such incident, the taxations were like with indexation, without indexation, wherein the 20% and 10% were the criterias. Now they have come to a flat rate of 12.5% for long-term capital gain without any indexation. So what is an indexation? It is nothing but an cost-adjusted inflation. Wherein let's say if I'm purchasing a property in 2006 and I purchase it for 100 rupees, and I'm selling that particular property in 2024-25. So I have an inflation index and I calculate what would be the present cost of the 2006 purchased property. And that inflated cost, I can adjust it against my sale consideration and arrive at a capital gain. So this is a criteria wherein long-term capital gain in India is taxed at 12.5%. A small change which has been made in 2024 budget was, so basically wherein a finance minister introduced a concept wherein if any purchase of property has been done on or before 23rd July 2024, the person who is selling the property has a dual advantage wherein he can consider flat rate of 12.5% to arrive at the capital gain taxation, or he can choose for indexation benefit and go for a 20% taxation. So where we can compare both, which is more suitable for the individual person, and accordingly determine the taxation for long-term capital gains. And accordingly, in the short-term capital gain is taxed as per your slab rates. I'll just take 1 minute, just 1 minute, sorry. Hello.
Yeah, you're clear. Can we make it in under 5 minutes?
Yeah, it should get over.
Yeah. Thank you.
So yeah, so in this particular long-term capital gain, we get two advantages, wherein if the property is sold in after 23rd July, we can opt for old rates or new rates based on the tax computation and wherever we are getting advantage. And in case of short-term capital gain, it's simple. Whatever your income slab rates are there, basically you might be falling in different slab rates. Whatever the slab rates are there, you will be taxed according to the slab rates. Same for mutual funds as well as equity shares. So if you're holding it for more than 1 year, you will be taxed at 12.5% in case of long-term capital gain, and in case of short-term capital gain, you will be taxed at 20%. So again, in mutual funds, you have debt funds and equity funds. Debt funds you have to hold for 24 months to be able to get an advantage of LTCG, and for the short term, it's less than 2 years. The only change in mutual funds is that your gains, whatever you are having, you have an exemption up to 1.25 lakhs. If you have a gains more than 1.25 lakhs, let's say 2 lakhs, you will be only taxed for balance 75,000, and 1.25 lakhs is an exemption in terms of equity and mutual funds. So what are the compliances required for NRI in terms of IT filing is, if this income exceeds 2.5 lakhs, so he has to compulsorily file his IT return. And if he wants NRE repatriations and interest taxable repatriations are also available for him based on the conditions what he follow. And we can also help him with maintaining the NRI status in terms of tax planning, how it can be done and how to use the DTA provisions and minimize the tax burden in India. So this particular where we discuss about what is DTA, what are the benefits of DTA, and what are the foreign tax credits. So basically, DTA is an agreement between the two governments or two countries wherein they give us a benefit of tax benefits wherein they enter into treaty, which is legally binding. So what is the purpose? Is granting relief, avoidance of double taxation, wherein a particular income is being taxed in India as well as in Germany. So it allows us to avoid that double taxation, and there is also for exchange of information between the governments. So there are two particular sections, Section 90 and Section 91. Section 90 works when there is a DTA between India and other countries, and Section 91 works for where there is no double taxation agreement between the two countries. So I've given few FAQs for better understanding about the sections and DTAs, which you can go over once I share this particular slides for your exemption, for your readings and for your reference purpose. So I've given a brief DTA wherein most of the DTAs which we have analyzed, what are the areas basically gets covered in the DTA. One is residence. It defines about the residency, tax residency, global income, and other tiebreaker rules. And what is the taxation for an income from employment? What happens in DTA? Then director fees, artists, how it has been, how can we use DTA for directors, artist fees, pensions, students, other income. So it is basically a broad view of all the categories which a person might be having and how DTA can help in reducing the taxation. So I've given a prominent DTA key benefits in Singapore. For example, I've taken 3 countries, Singapore, USA, and UAE. So for example, royalty fees or for technical services, DTA says that in India, to be taxed at 10% for India and Singapore DTA, whereas for USA it's 15%, and again for UAE it is 10%. Same way for interest income, capital gain, and dividend income. So it's just a broader view for where major transactions with India happens. Usually it's USA, Singapore. So that's why I've taken this particular example just to have a understanding how the DTA works. So let's say when I was coming about the foreign tax credit, which is very much important, this particular concept is a relief for double taxation. Basically, a tax paid in source entry is allowed as a credit by residence country. Wherein, let's say, for example, I've paid a tax for a certain income, which has to be declared and disclosed in India also. For example, it might be a simple interest income, which is getting taxed in Germany as well as taxed in India as well. So whatever taxes I am paying in Germany can be taken as a credit while filing my returns in India. So basically, it is by virtue of avoidance of double taxation. And Section 91 it provides Section 90 and 91 it particularly deals with. To give a better understanding, I've given an example for this. For example, Mr. Sharma, an Indian resident who was earning 10 lakh from USA and pays 2 lakhs as tax, there his Indian income is around 12 lakhs, making his total taxable income is 22 lakhs. India follows 30% tax rate, so his Indian tax liability is 6,60,000. So basically, I'm taking tax credit method and exemption method. Tax credit method, what happens is Indian taxable income is 22 lakhs, and by virtue of 30% taxation is paying 6,60,000. But he's already paid a tax in USA for, let's say, 2 lakh rupees. So he is taking that credit and disclosing while filing IT return under section 1991, saying that he has already paid 2 lakhs. So Indian tax payment is around only 4,60,000. This is how FTC works, basically giving relief to the person for double taxation. So what are the limitations and challenges in foreign tax rate? Basically, carry forward and backward does not allowed in India at all. So you cannot carry forward whatever taxes you have paid in the previous year to the next years. And there might be mismatch in tax years because of different financial years being followed. And there might be certain restricted tax credits if the foreign tax paid is disallowed or refundable. Based on a case-to-case basis, there are certain limitations and challenges in FTC as well. Then there's some practical considerations which I have given for a reference purpose. And then I've covered one case study for NRI selling a property in India. Mr. Raj, who was resident of India, and he's selling a residential property for 2 crores. The property was purchased for 80 lakh, and buyer must deduct TDS. Okay, so basically, Mr. Raj has considering that he has purchased this property before July 2024, he can go for 12.5% taxation or 20% taxation with indexation benefit based on what is more feasible and where his taxes gets reduced is what I've analyzed. I've taken consideration only 12.5% plus surcharge and TS says. I've considered this particular example for your ready reference for your future transaction. And also one more case study which I've involved is freelancer learning from multiple countries and how we can use this FTC benefit by virtue of DTA. That has also been summarized here.
Yeah. Wonderful, Akshay. For the benefit of everybody, we will be sharing the presentation. Akshay, yes. I'm taking your consent to share the presentation, and we have received a lot of questions, from the NRI forum here, right? All the yes. participants. So we will definitely answer all the questions. We'll give some breathing space for Akshay. I'll be completing my presentation now. Maybe I'll take exactly, right now it's 4:30 IST, right? So I will complete my presentation maximum in 20 minutes, and then I'll take all the questions for Akshay. So Riaz, so I'll be starting my presentation now. So I'll be talking exclusively on how to attain passive income from the Indian context for a German, right? And I'll also be touching base on the financial freedom and the time freedom concept, right? In the meantime, Akshay will prepare all those questions. I think so we have received some good number of close to around 10-12 questions. All those questions definitely will be answered as this is one of the most important sessions from the tax perspective. Is it okay, Riaz? What I'm talking makes sense? Riaz, you are there?
Yes, sir. You can go ahead, sir. In the last, we can take the Q&A.
You can text Riaz. Yeah, boys, please start sharing the presentation. So the saying goes like this: if you do not find a way to make money while you are asleep, you may have to work until you die. So it's not how much money we make generally. It is all about how much you save. There is a very, very beautiful formula when it comes to saving. But most of us don't use this formula. It's called I minus S is equal to E. What is this I minus S is equal to E? It's nothing but income minus saving should be equal to your expenditure. So let's say your income is 100 rupees, right? Guys, we don't need the video now, right? So if your income is 100 rupees and the formula says at least you should save 30-40 percentage of that. So let's say if you're earning from a European context, right? If you're earning in European currency, if your earnings are 100, right, then you should save at least 25 to 30% of that. So that's what it says. and the remaining should be expenditure. But generally how we do is income minus expenditure, then we try to save, and we end up failing miserably in the saving aspect. So I was talking to you prior to Akshay that in India right now the situation is markets are down. Well, nobody better than Warren Buffett has given this amazing philosophy for all of us. When there is greed in the market, we should actually exit. When there is panic in the market, you should buy. Actually, if you look from an Indian context right now, it's a panicky situation. Why panicky situation? Last 4 years, post-COVID markets never saw any kind of a crash or a turbulence or a correction, in spite of some incidents like geopolitical Russia-Ukraine war, or the Israeli-Hamas, or the Syria conflict, or the Hindenburg and Adani, saga. In spite of that, we saw markets in India being doing phenomenal because of the one Indian domestic participation in the FII participation, and also the consumption, story of India. In fact, Chinese market have not done good for last 7-8 years, but definitely of late China has picked up because of the infusion of stimulus, to Chinese economy. Somewhere around $50 billion dollars was infused to the economy. So that has really revived the Chinese economy, because after COVID they have been very badly hit. And Europe was shattering because of the Russia-Ukraine power and energy crisis, as we all know. Right? Germany is also not in a good state because of the inflationary and also the price hike challenges, right? And the interest rates being very high. So all this was a crisis scenario to the world, but not for India. So what we are witnessing right now in India is a small correction, I will say, but a fantastic opportunity to participate into the markets. So here I would love to share something very phenomenal. There's something called as 4 quadrants, right? When it comes to financial asset class, we talk about equity, we talk about debt, we talk about commodity, and we talk about real estate. Mahesh, can you go to that slide now, the 4 quadrant slide? Yeah, one previous to this. Yeah, thank you so much. So I hope my slides are visible to all the participants. Here we have equity, debt, commodity, real estate. Well, when you participate in equity, you generally get dividends, right? In the form of returns. The return on investment when you invest in equity is dividends. Similarly, when you invest in debt, that is, I'm talking about post office or fixed deposits or bonds or government securities or GSEC instruments or NCDs, non-convertible debentures, right? Generally, you get interest income. Similarly, when we invest in commodity, that is yellow metal, gold, nickel, copper, silver, there are 2 kinds of commodities for the benefit of all the investors, right? Metal commodity and non-metal commodity. When I say metal, I talk about gold and silver. When I talk about non-metal, we talk about something like spices, coffee, tea, all these which are traded in the market, So they are coming out of the agri commodity segment. Now, what happens when you invest in commodities? You get appreciable income and also dividends. Similarly, real estate gives us rentals. Real estate gives us passive income. There is something like residential real estate, commercial real estate. We have agricultural real estate. We have fractional ownership in India. We have industrial warehousing real estate. All this gives us a rental, income when you invest there. Now, the entire objective of Akshay or me, who have come here as financial consultants and wealth consultants for this forum, is to create a portfolio income out of these 4 asset classes. That is from dividend income, interest income, appreciable income, or rental income. The total money coming out of these 4 asset classes from equity, commodity, real estate, and debt is known as portfolio income, or it's known as passive income. So the day your portfolio income is greater than your active income. What is active income? Active income is nothing but something which you are putting efforts, your sweat, your blood, your energy, your intellectual efforts, your time, your complete knowledge sharing, and your dedication is actually known as active income. Now, how can we all retire? How can we be financially free? How can we have a lot of time freedom? Which is really the ನಮ್ಮ ಕನ್ನಡದಲ್ಲಿ ಹೇಳಬೇಕಂತ ಹೇಳಿದ್ರೆ ಯಕ್ಷ ಪ್ರಶ್ನೆ ಅಂತ ಹೇಳ್ಬೋದು. right? Which is $1 million question for all of us, right? How is that I can get my time freedom? How is that I get money freedom? When you participate in these 4 financial asset classes and create portfolio income or in the form of passive income, and if that is greater than your active income, what is your active income? Active income is your annual income, your annual output of the time and efforts which you are putting on a month-on-month basis. So your annual or your monthly income may be in terms of, let's say somebody is earning 15 lakh rupees, 20 lakh rupees from an Indian context, that is your active income. The day your portfolio income, right, beats your active income, all of us can set free. That means it is not compulsive for us to go out and work. That's the reason there is very beautiful formula which I'm going to share it on the desk now. It's called P greater than AI or PI greater than AI. Mahesh, can you share that slide? PI greater than AI. Mahesh, next slide, please. So what is this PI greater than AI? A portfolio income greater than active income, right? Here it is portfolio income greater than earned income. Here it is EI. So it's nothing but active income also. Mahesh, can you come back one slide down? Yeah. So one of the most important takeaway for this entire German 53 people sitting here today can be this, we call it as the financial pyramid. It basically, as if you see, there are around 7 clear indicators or arrows there. Now, let me make it very simple by making it understanding in less than 2 minutes. The first arrow is called income security. Now, what is the income security? Let's say Riaz has got an income of 1 CR from an Indian context per annum. Now, there is a lifestyle, of at least 5 lakh rupees from a German context on a month-on-month basis. That means his family requires close to 60 lakh rupees every year. Now, can we replace that? Now, we can replace that only if there is basically an alternative income, and that alternative income is nothing but income security, or you can call it as life security. So, generally, the thumb rule is annual income into at least 10 times. So if Ria's income is 1 CR from an Indian context, 10 times is 10 crores. So that's the family security income, what we call, or 20 times, right? 20 times is 20 CR. So what happens when there is 20 CR? If he puts in, in Germany in bank account, that will give at least 5 lakh rupees to 10 lakh rupees on a month-on-month basis, which can ensure that the family lifestyle is intact, even in the absence or in the presence of Riaz. So it's a very beautiful example. Once again, let me share it. Right, in the absence of Riaz also, the family's lifestyle is taken care with that 20 times income security plan. From an Indian context, if somebody is earning, say, 50 lakh rupees per annum, and 20 times is like something like 20 into 5, 10 crores. 10 crore in a post office or a fixed deposit will definitely fetch roughly at 5% around 50 lakh rupees. So that 50 lakh rupees is still coming even in the absence of the breadwinner, is what I'm trying to say here from that financial pyramid. So that's the number 1 arrow, which is called income security. Now ask yourself one question: am I adequately financially secured from the family perspective? Have I taken care of my beloveds? Have I taken care of my dependents? In my absence, is the income still coming to family? Is the most important question we can all ask at this juncture. I'll go to the second arrow, and we bring the second arrow on the slide, which is called as health security, or basically something which secures all my bills if I'm hospitalized. Right? What is this? It's called as health insurance also, in other words, in simple words, in layman's language, but I call it as having adequate financial security when it comes to health. That's the second arrow. It's called health protection. We all witnessed what happens in COVID. Many families have been thrown on the streets today because of not having adequate health protection plan. Ask yourself, are you adequately covered? Are you spending from your wallet, or if you are hospitalized, there's someone coming and taking care in the form of health insurance? It's not going from your saving bank account. It's not going from your liquidity. It's not going from your income. It is going exclusively from the health protection plan. That's the second arrow. The third arrow is, dreaded disease, critical illness, riders, accidental riders, income loss riders, right? Very, very important. This is very popular in Europe. In India, it's yet to pick up these riders, because riders give us money to fight back in case of any kind of casualty, in kind of any eventuality, in kind of any emergency, in kind of any health serious upset, falling sick or temporary disability, permanent disability. So this is where you are compensated. You will get back the sum assured. Let's say you have taken a 10 lakh rupees, a 20 lakh rupees compensation plan. You will get back money to fight the disease. That's the third arrow. Fourth arrow is very, very important from the global perspective, Indian perspective, German perspective. In India, we neglect it a lot. Today, a lot of families fight amongst brothers and sisters in the court, in the civil courts, because there is a simple will missing, nominations missing, succession planning missing, estate planning missing. Do you know 1,500 rupees to 5,000 rupees from an Indian context, you will get a will. Kannadadalli ನಾವು ಉಯಿಲು ಅಂತ ಹೇಳ್ತೀವಿ, right? So a will not cost more than 5,000 to 15,000 rupees if you customize it. Not having it, families go into conflicts. Brothers and sisters, unfortunately, fight in the court, ending up in delayed, compensations. So a will is mandatory, and that's where a financial planner like me or Akshay can be very handy for all of you. So I'm coming to the fifth arrow now. Emergency fund. We all know at least 6 months to 12 months of money should be there kept in fixed deposit or income funds or money markets, to make sure that our lifestyle is not disturbed in case of any job loss, in case of disability, in case of something going wrong with health, in case of if I'm hospitalized. So at least 6 months to 12 months kind of a compensation plan is known as exigency plan or contingency plan. And the sixth but not the least is asset protection. Now we have jewelries, we have assets, we just spoke about physical assets, and we spoke about financial assets. All this can be secured, right, through an asset protection plan. And last but not the least, mortgage liability protection. Let's say you have a 1 crore liability, you cannot impose this on your family. In your absence, it should not fall apart on your family. It should vanish with you if you are not available to your family. And that can only happen when you have a liability protection plan in place. So this is one of the most important aspect I'm discussing is this: if you have defensive planning, your wealth is secured. It is like, India spends a lot of money on every budget. The majority of the money goes to defensive planning, defensive strategies to secure the interest of the country by securing our border. That's the reason India has a danger border across one side China, one side Pakistan, one side Sri Lanka, one side Bangladesh, another side, few more countries like Nepal, Bhutan. And so we are always facing danger from these neighborhoods. And the majority of the money we spend on an annual basis is for our defense. Similarly, in financial life, you must take care of your defensive planning, which comprises of these 7 arrows. If this is taken care, your wealth is intact. Let's say if you have 5 crore and for net worth, and if you have to spend on these, right, that's poor financial planning. So financial planning is all about thinking for the future and taking care of your very basic essentials and securing your wealth through proper defensive protection plan. So let's move on now. Now I'll talk about one of the most important aspect. I'll give a formula for all of you, which you might love it, right? It's called 1248 formula, right? It's called as how much money, I will talk from an Indian context, how much money if you require for your lifestyle, you can call it a day and you can retire. Let's talk about it through this beautiful passive income formula called 1248. Right, here we go. Can we go to that slide, Mahesh and Dheeraj? 1248. So let's say I'll take example of someone here by name KS and Arindam. I saw in the chat box. Let's say Mr. Arindam has a monthly lifestyle of from an Indian context lifestyle income of only 50,000 rupees. So what can avail 50,000 on a month-on-month basis from an Indian context. Now, let's say if you have a fixed deposit or a post office deposit of 1 CR. Mahesh, can we change the slide, please? If we have a 1 CR, put it in a fixed deposit or a recurring deposit, right? That will easily fetch 6% per annum. So 1 crore is what? 6 lakh rupees. After all the taxation, let's say if you get 6.5 to 7% interest in a good post office senior citizen scheme or NSC or a PPF, right, you definitely get around 7.5 to 8%. So I'm taking 6% as an average. So if you are depositing 1 crore, you get 6 lakh rupees. That is exactly 50,000 rupees per month. If you divide by 12 months, so you get easily 50,000 rupees on a month-on-month basis. So Mr. Arindam has 1 crore and his lifestyle is taken care. So, but it may not be forever because inflation is another big question. So it's good. Arindam should plan for 2 crore. What happens if 2 crore is kept in a post office? It fetches at least 1 lakh rupees. Can we see that 1248 slide, Dheeraj? 1248 slide, please. 1248 slide, the previous one, please. So if Arindam has close to 2 crores, it will easily fetch him 1 lakh rupees per month, which is a decent enough income. But if somebody's lifestyle is more than 1 lakh rupees, somebody's lifestyle is say 2 lakh rupees, right? They need to keep at least 4 crore rupees kind of they have to arrive at 4 crore rupees. So here is this level 1248 I'm talking about. So I call the first level of Arindam's as financial emergency. Having 1 crore will fetch him 54,000 rupees of passive income per month. Level 2 is financial security. If you have 2 crore rupees as net worth, and if you have deposited in a fixed deposit, and that will easily fetch you 1 lakh rupees per month, right? And that will take care of your financial security. Basic needs like roti, kapda, makan definitely are taken care. But somebody's aspiration is even bigger. Let's say Arindam is not happy with his lifestyle of 2 crore. Well, he can aspire for having 4 crore rupees. That will easily fetch him 2 lakh rupees per. I'm talking from an Indian context here, 2.1 lakh rupees per month. That is passive income. Now, even then, Arindam is not happy. Then he can move on to level 4 from financial independence to financial freedom, right? So financial freedom is if you have an 8 crore net worth, 8 crore corpus, that will easily fetch 4.3 lakh rupees. I'm talking from a pure post office fixed deposit. But if we put this money into mutual fund, I will show you one great, amazing example, right? What 1 crore can do, what 1 crore has done in India from an Indian context. If you put in a mutual fund in a systematic withdrawal plan, I'm just sharing this as an example, right? One of the examples now for you. Go to that SWP slide, Mahesh. 1 crore live example, 1 crore live example of SWP. Thank you. Yeah. So do we have this complete 4 or 5 slides, Mahesh? Yeah, thank you so much. For example, somebody deposited 1 crore in 1998. There was a fund by name HDFC Prudent Fund. If you invested, they were giving at that point of time 1% kind of a dividend. So what is 1% of dividend per 1 crore? It is 1 lakh rupees. So you are allowed to withdraw 1%, from your own corpus dividend. That is 1 crore. 1998, you deposited 1 crore and you started withdrawing 1 lakh rupees every month. So we have already 27 years from 1998. That means it's close to 324 months. So Arindam has withdrawn every month 1 lakh rupees. That is 3.24 crores has come back to him after depositing 1 crore in this fund. And the best part is even after withdrawing 1.24 crore, here a very, very notable point here. In the last 27 years, we have witnessed every kind of crisis on the earth. We saw Ketan Parekh, Arshad Mehta scam. We saw Raja scam, Fodder scam. We saw Lalu Prasad Yadav scam. We saw Commonwealth and 3G, 4G scam. We saw Bofer scam. We saw Rafael's, scam. We have seen couple of wars. a global Lehman crisis in 2008. I'm sure all of you are aware. And off late, we saw COVID. And now we are seeing the Trump trade and the T-Cube one, the Trump trade and tariff one, Hindenburg. So we saw so many crises. These are all events. In spite of that, it's pretty difficult to believe what I say because this is a live example. Your 1 crore after withdrawing 3.4 crores in 27 years into 12 months, that is 324 months, is standing today very healthy at a portfolio of, can you go up, Mahesh, can you show the final Excel? Yeah, the final picture, what might be the current value? After completing 324 months, the current value stands at 104 crore, 39 lakh, 37,155. So in this example, the client has withdrawn 299 months, that is 2.99 crores he has got back. After withdrawing, the current valuation stands at 104 crore, 93 lakh, 71,055 rupees at an XIRR of 24.27. So this is the power of the Indian equity. What I'm trying to share here is this is the power of India's growth story, right? How there are 5,000 schemes in India, right? You know, at least 500 schemes have performed beyond 15 to 20% in India, right? In fact, there is a disclaimer. You need to take advice. You need to basically do a lot of R&D. You need to basically consult a consultant before you jump into any funds, right? But this is the fact. The power of the equity, the power of Indian economy. 1 crore deposited, withdrawn every month 1 lakh rupees. After 324 months, it stands at 104 crores. That's the power of compounding, I will say, which is the 8th wonder in India. So, well, the Indian growth story continues and is very much intact. For all your information, right? That's the reason we must trust in the Indian economy because we are a very youthful nation. Currently, our GDP is 7%, our inflation 6%. If you club, India is actually performing at 13-14%, sailing through, right? Our per capita is at $2,500. Our we are a 3.8 trillion economy when it comes to GDP again. So China was in the same phase 20 years back. Today, they are 5 notches above India. Today, they are sitting at somewhere around 15-16 trillion economy with per capita income of around 13,000-14,000 US dollars. So that is where India will go towards. It may take time, but we are definitely heading there. In the next 4 or 5 years, we will definitely be one of the 3rd largest economy with the kind of consumption story what we have with 70 to 80% of youth filled with India. So we are all set to basically climb there with a better infrastructure. Recently, I'm sure all of you noticed the power of India was derived through its Mahakumbh. 60 crore people assembled in this biggest event of the world, right? In the last 1.5 months. That shows that also brought 4 lakh crores of exchequer to UP, Uttar Pradesh government, right? So that's the power of India I'm sharing. We are a very powerful economy. We're facing a temporary setback, which was very good for India because correction is a must for any economy. Otherwise, you can't simply keep going up, but we'll bounce back for sure, with flying colors, right? So that's it from my side, Riaz, right? There are a lot of questions for Akshay. I believe Akshay will take up some questions, right? In fact, we wanted to keep it for 1 hour, but since it was tax planning, Akshay took some more time. But I believe it was relevant to the forum and to the audience here. There are 51 audience. I see very strong audience here. And Akshay will definitely take some questions. Before I wind up, Riaz, I have one small gesture because since we have sponsored 1 year, the RMKS. We would love to give a complimentary financial services for the crowd here through a small risk profiler. My team will basically share in the chat box a small risk profiler. So I request all the participants, 51 participants here to answer this very simple risk profiler so that, whoever successfully answers these questions, we will get back to them on a 1-to-1 and give a complimentary financial planning, which is worth around 25,000 rupees. I'm sure Riaz, you have taken this financial planning and I'm sure you have benefited from this. So one more thing I want to tell the audience, WinNest as an entity will not take any money. We are just an intermediary. We basically deploy money into Indian stock market through mutual funds to primary and secondary market through a lot of risk profiling and through prudence, right? We will not take money. We are just a plain intermediary. We just, provide solutions, is what I would love to reiterate here. So Ajay and my team is basically putting in the chat box this beautiful small clip. So you guys can really go to there, download it and basically address that. Mahesh, are we ready with that? Yeah. Here you see in the chat box, you can see a small the clip, right? You can basically, it's a Zoho questionnaire. So it's a small risk profiler which will show you what is your financial personality. You can basically download it. Now over to Akshay. Akshay, you can take up all those questions. I think so. You're already prepared. So here we go, Akshay. Please.
I think the couple of questions what I could see in the chat box is like Mr. I think SM S911B has asked whether we have to file our returns if our income is about 2.5 lakhs. From my suggestion, yes, sir. Please go ahead and we need to file our IT returns. And sometimes what happens is even if our income is less than 2.5 lakhs, and if we are keeping our income in FDs and post office, there might be, because of an NRI status, you might be subjected to tax withholdings in India. And provided even if it's less than 2.5 lakhs, I can advise you to go and file the IT returns and claim the refunds in case if you're getting the refunds, and you should go and file the returns. That is my suggestion. And if it's more than 2.5 lakhs, yes, you should file your IT returns. The second question, what I got it from Mr. Prahalada is with respect to example, person has a non-Indian passport, no earnings in India, but person has a rental income of 2 lakh rupees per year and has a housing loan in India 1.8 lakhs per year. How much he needs to pay for the tax filing, how the quotation is calculated. So for the rental income, there is a standard 30% deduction available. And out of that, we have to consider your other incomes, which is there. It might be in terms of your interest income, FD income, mutual funds. All of those income will be clubbed. And you can claim in terms of housing loan up to 2 lakh rupees as interest on loan and ATC benefit, provided you choose an old regime. In the new regime, there is no, all your incomes will be clubbed and there will be no exemption with respect to deductions on housing loans or any other deductions. And does NRI need to pay tax again in current living country if he has an income more than 15 lakhs a year? For that, your Germany taxations, what I suggest is you need to consult your local chart accountant or a CPA. And with the Germany and Indian tax DTAA, you can claim the foreign tax rate, which I discussed with you in the previous slides when I was discussing with you. You can claim it, and for more benefits and filings, you can contact Germany tax CPA for your Germany filings, and you can connect with us on a one-to-one basis and understanding what your other incomes are there and in India and how we can go about it is one. And I think a few people have requested me with respect to 15 lakh limit for NRIs. I'll just, if I have 1 minute, can I go over it again? Is it possible, sir? Hello?
Yes. You can go ahead.
Yes, so basically that NRI 15 lakhs condition was with respect to determining whether residential rule, which was discussed in slide 1. So just to summarize in, if I have to consider as an NRI, I should stay first of all less than 182 days. If I'm not satisfying that 182 days, then I look in for the second condition that, let's say if you have stayed in India for 60 days or more or in 365 days, if both the conditions are not satisfying, I'm an NRI. But there is a special condition for NRI 15 lakh rule. If an NRI is income in India only from the sources of income in India is 15 lakhs a year, and he stays in India for 120 days or more, but less than 182 days, he will be considered as resident, but not ordinarily resident. Basically, he'll be resident, which is terminology called as RNOR. He will not be an NRI, but he will be an RNOR, and his income outside India will not be taxed. And only income in India will be whatever income is there in India will only be subjected to tax. That is I think the confusion with respect to 15 lakh criteria was a special condition for NRI earning more than 15 lakhs. So is there any other? So if an NRI, you have no income in India, but you are still having an housing loan, so you don't have to file your returns unless and until you have any TDS impacts or any other taxation impact in India. Only then you are required to file. By mere housing loan, you will not be required to file IT returns in India. So the indexed value of property, what happens is it's every year, like Government of India comes with an indexation cost of inflation index. So it's been published in all the websites and everywhere. We take out that particular value and we appreciate the value of cost. In case if we are choosing it to be taxed under 20% with indexation benefit. But if you are not going for indexation and going for a straight 12.5%, you don't have to have an indexed value of the property. For NRI, if there is ITR1, ITR2, but again, I would like to say we need to consider all your other incomes. Based on your incomes, we can choose between ITR1 and ITR2. Will you help to do? Yes, sir. I think family trust. I think Uma, we can help them in having that. And even NRIs are eligible for all the exemptions. They can invest in government bonds, REC bonds for capital gain, and otherwise, from the investment angles, I think Uma and the team, WinNest team, can also help you with other investments in government-related securities.
Sure, we'll be taking care. And there was one more direct question. So we says that okay, how NRI FD interest taxed in Germany? Okay, as per DTAA.
So NRE FD deposits are interest-free and are tax-free in India. There is no taxation in India for NRE FD deposits. So there is no question of DTA in that. So whatever your Germany taxation is, only the impact of will have an impact on your tax filing. So from Indian point of view, NRE FD the interests are exempt.
Okay, there's one more question from Harisha. If an Indian citizen is having Indian salary and going around on Peridians, is he NRI even if he is staying outside India for more than 183 days?
Yes, if he's more than 182 days, and if in the second slide first slide we were discussing, and by virtue of his employment, he's going outside India and he stayed in India for less than 182 days, then he's a non-resident. If we're staying more than 183 days, then we have to go for the second condition, 60 days and 365 days. And if all the conditions are met, we have to tell him that he's a resident, and accordingly, his global taxation will have a point impact in India.
Yeah.
Akshay, please share your mobile number to the benefit of all the participants there. So please.
I'll just put it over in the chat. I've just shared it in the chat.
Uma, please also put it in the group also.
Yes, sir. I'll be sharing details of Akshay as well. Okay. And
Uma, once again, you can share the participants the complimentary, financial planning for the people who fill the risk profiler. Please share the clip once again.
Sure, sir. And please note, we have Germany clients exclusively one WhatsApp group. Okay, I request all the candidates to join. Okay, we'll be sharing the joining link as well, where we have been educating all the clients. Okay, so to have the more information part. Okay, whenever you are interested, you can get back to us as well. Okay, and one more request is please fill the profile which has been shared. Okay, and I think Mr. Riaz has a question. Yes, Ms. Riaz, you're able to unmute.
Yeah, Riaz Aure, namaskara.
Yeah, thanks. Thanks for the details. See, the key concerns that I heard from some of the members were really related to the investment plans, and then how exactly that funds can really be brought in into Europe, especially for investments. So most of the people who are there are looking forward for investing in home, right? So that's one of the key concerns they had. Should we really invest in India, or should we really invest that in Germany? So maybe that you have to address it at a higher level. Were you able to hear me clearly?
Akshay, you can take
Yes,
this question.
so
And
yes,
also,
sir. So whatever
Akshay,
you're
can-
investing in India, no. So there is a there's a free investments in India. Basically, that do not need any approvals from RBI while investing. And for the same, when you're doing a repatriations from India, and if you're repatriating out of your gains from mutual fund or sale of property, there's no special requirements. You can easily repatriate back whenever you require. We help our clients. Recently, we helped a client from Singapore and as well as US to repatriate his excess funds out after paying whatever the taxes to his Singapore and US, and there he invested again in his house property. And there was no legal hurdle and there was no hurdle from the banks while doing the repatriations. So yes, you can go back whenever you want to liquidate your funds and in India or property and repatriate back to your source country for further investment. Or you better, what I suggest is you can keep in India those money, because India has a lot more opportunities than any other country, since we are a developing country and the GDP and which I think sir can take it forward from there.
yeah.
Why
Thank you so
investing in
much.
India is more here.
See,
Riyaz,
the main,
investing in India is
the
definitely good.
follow-up question on that, Akshay and Sunil, is basically, see, we keep the funds basically for security. Okay, we addressed all the 7 arrows you showed. Now there is
Okay.
also a need for that funds to be used and utilized and enjoyed, right?
Correct.
Now,
Correct.
one of the key topics is how do we ensure that we use it at the same time not lose on taxes? Because the key balancing act that the people are thinking here is while I'm an NRI, I'm investing in Europe or in US, I pay my taxes in Germany. Now, why do I need to earn the same in India? Maybe the markets are good, fair enough. But when I repatriate that amount, I pay taxes. So will it not be a break even, or sometimes I might also land up losing money there, right?
No, you can utilize about the DTAA agreements between India and Germany, and as well as the foreign tax credit. So whatever your income is getting taxed in India, and the same likewise if it's getting taxed in Germany, you can utilize the DTAA benefits so that you avoid double taxation agreement avoidance as well in that case. And there are also instruments available in India to avoid taxes by making certain investments. For example, if you are having a capital gain, you have an option for saving taxes for further. If you're investing that capital gain in certain bonds or properties a certain extent, you can utilize them for your tax saving. And whatever the balance money is left in India, you can easily repatriate to your source country. So those instruments and options can be explored based on the individual risk appetite, and we can take it forward and help them as well in this regard.
So a follow-up question on that, Akshay. For example, if in India we have a taxable percentage of say 30%, right, as of date, and then
It's
in
highest
Germany it
levels.
might be, depending on the social status, it might go up from 24 to 40%, depending on the social status, number of
Correct.
kids, married,
Correct.
unmarried, etc. So after paying the tax, whatever is the balance tax based on my tax class in Germany, I have to pay that anyway, right? So the key question here is, what is the best?
Sir, actually, if you're comparing India and Germany, if you see the capital, the other income is all taxed as per slab rates. But if you're comparing the capital gain taxation, in India, the capital taxation maximum at present in the situation is around 14.95 to 15%, which is far more less than the capital gain taxation in Germany, which is around 26-27%, if I'm not wrong, in that case. Not all the incomes are taxed at 30%. There are capital gains, long-term capital gains are taxed at much lower rate of 12.5 to 15%.
I hope you got the answer, Riyaz. See, one, because we are an emerging economy, one from an equity perspective, we have definitely, you can expect a double-digit return in this country on another 15-20 years. Even if from a debt perspective, India is a country still giving, it's, yesterday I was reading, our senior citizen gives around 8+. Most of the post office, instruments give more than 7.5% returns even in India. And our debt mutual funds are also giving between 6 to 7%. There are credit risk funds. I was in a presentation in Delhi. One of the our non-convertible debentures like Neo Finance, which is Sachin Bansal's company, who himself has invested around 2,700 crore, is giving around roughly 11% kind of a return, in a fixed deposit in a NCD. So in India, you should really, they say, when the sun is bright, you should make the hay. Like that, India is that economy for the next 10-15 years. If you look at German, the returns rates on the government bonds and the Indian government bonds, there's a stark difference, right? We are able to give at 8%, where they are able to give at 3 to 4%, right? And that too because of the interest rate hike after the COVID. Otherwise, it was even hovering around 1 to 2% in the entire Europe. I think though you should work, and simultaneously you should put some money also to work in the stock market in Germany. But if you ask which is the best destination, it is definitely India. FIs have pulled out money because why? They have gone to China for a temporary period, because right now China is giving around 40%, but that will not be long lasting. Again, they will look for opportunity which is lowly priced. Again, India's correction is an opportunity for anybody to participate and create humongous wealth. The 14%, 15% correction, what we have seen, is a real opportunity for India right now to plunge into equity and really take. I'm talking from a long-term perspective, never from a 5-6 year perspective. It is beyond 7-8 year perspective. Well, India is the destination if you're looking at, because last 40 plus years, India has produced an average 15% CAGR, compounded annual growth rate, year on year for a sustained investor. And that is phenomenal kind of return, success story. And we are a very young, youthful nation. This is just the beginning of India here. Tesla is just now coming to India. You guys have seen all the top versions. So we are still 30 cars per 1,000, whereas China is 300 cars per 1,000. So that India will go from 30 cars to 300 cars. Same thing with refrigerators, same thing with our AC, same thing with two-wheelers, same thing with every consumption, same thing with automobile, same thing with EV, same thing with power. We are a nation to watch for the entire country. After China, we are the manufacturing hub for the world. Because the youth, because the population, what was cursed is a blessing in India. Look at Europe, it's an aged nation, right? Nothing gets produced there. Right, I think so. They are almost out of the cars manufacturing. The Volkswagen and the other Mercedes-Benz are all doing not great there. It's almost like a shutdown phase. So India is the next destination for consumption and even for production. Because why? Cheaper production, cheaper valuations. So I think so. It's the India to watch out for the entire world, and we are a peace, loving nation compared to the entire world. Right now, the entire world is fighting amongst each other, but we are the one taking a neutral stand. We are on Ukraine side. We are on Russia side also. We are not, we're not anti anybody. So that's basically the Indian story, and we are just the beginning. The race has just begun in India. So I think so. Some portion of money must bet in India. Be it government bonds, be it government securities, be it equities, be it equity as phenomenal opportunities in the form of PMS, in the form of startup equity, in the form of unlisted shares, in the form of alternative investment funds, in the form of REITs, real estate investment trust, in the form of infrastructure investment trust, in the form of P2P, power to P. It's a huge topic. I can probably get a lot of speakers for every topic, for PMS, for alternative investment funds, for unlisted shares, for AIF, right? I can organize a lot of workshops for each of these topics, coming forth for the German crowd. That's the opportunity in India, right? India is 70 lakh mutual crore assets under management country. It is going to become 700 lakh to 1,000 lakh crores in 10 years. 10 years back, we were just a 10 lakh crore assets under management in mutual fund. Only in 10 years, we have piled up 70 lakh crores with the participation of only 5 crore. People lose money in something like Dream 11, crypto. People lose money in India and basically in these gaming apps. 17 crore people have put money in Dream 11 because of instant gratification. But the real wealth creator is mutual funds and the Indian equities for the long run. So I think so. It's an opportunity. There are 38 participants here. I mean, you should really look at India as a great destination. It's a blessing to be alive at this point of time in this country called India. So I think so. We have also offered a comprehensive plan free. Whoever fills that, please take advantage. We have put in the group also. I'll put in the chat box. Can you put it once again in the chat box, Uma?
Yes, sir. I've also put an WhatsApp group. Okay. So whoever
Grab
are
this
interested,
opportunity, talk to us, right? Take advantage of this comprehensive financial planning. You're ready to come on a one-to-one. You don't have to talk, in open public about your financial matters. We will keep the confidentiality, right? We are 2 decades in the game. We're managing on 400 crores of assets under management in Indian context, right? And we are a long-term player you can rely on, is what I would love to say. Over to you, Riaz.
Thanks for that insight and for the answer. Yeah.
Thanks for asking that question. Thanks for this opportunity, Riaz. Every time, you're going all out to basically bring in and educate people, which is very important. Financial literacy is very less. Riaz, the last thing I would love to say is across the world, 1% of the population enjoys 60% of the nation's wealth. Another sad thing is 60% has only access to 4% of the nation's wealth. So there is a big disparity. The rich is becoming richer, the poor is becoming poorer. The only way this can be overcome is through financial literacy. And that's what you're trying to help your crowd, help your people, right? So most of us are literate, but financially illiterates. Riaz, 4 lakh crores of money lies unclaimed in Indian, in different asset classes. 4 lakh crores, especially fixed deposit, that's 60,000 crores. Post office has a huge chunk of money. Insurance, right? And share market, EPF. EPF,
Yeah, in that PF, even my money is there.
60,000 crores, 60,000 crores of money lies unclaimed.
Unclaimed. Yeah, that's true. That's true. Yeah. Are there any further questions? Maybe we can take few if there are some hands raised. I don't know, Uma, if you can see.
Yeah, request anyone has personal questions, you can raise your hands. I also request who all have been, joined the WhatsApp group just to type me. And again, there is a profiler as well. I request even that to be going ahead so that it will be helping for us to get connected to you and help you in better way.
So one more point I wanted to add here, Sunil, is especially about why financial planning is important. Maybe you can add few words there, because see, my experience is I thought it might not be that necessary. And I've lost 25 years of my stay in Germany. I think I lost an opportunity. But probably if you can explain, if you were there 25 years ago, how I would have shaped up.
See, biggest benefit of financial planning, in the entire world, there are around 8.5 billion population, Riaz. Why the wealth is not equally divided is because people do not know what is goal setting. People do not write in a diary, right? The simplest reason I can tell you is why there is disparity. When they write, the subconscious comes into their aid. The universe will conspire and come and help them. Now, what we do when somebody signs up with us for a financial planning is we try to put them in that 1% club. We will talk about their goals. We'll make sure they're talking about their short-term aspiration, mid-term aspiration, long-term aspiration goals, and we'll start working with them. We'll do a review exercise. We'll always go back. We will revisit their goals. We will be coming back every 6 months once, and we'll be talking about whether they are they closer to their goals or not. The biggest benefit of financial planning is, right, whatever be the goal, be the educational, be their marriage, be their business establishment, being the retirement, right? So most of the people in the world cannot afford retirement. Why? Because they don't know what is the exact number to achieve a retirement as a corpus. Nobody understands inflation. Today, if your lifestyle is 1 lakh rupees from a German context, it is going to be 3 lakhs 15 years from now. Whereas you're 50, at 67, you'll retire in Germany. If today you're spending 1 lakh euro or 50,000 euro, you will spend 3 lakh euro, 6 times more because of inflation. Most of us are not aware how much money you require. From an Indian context, Riaz, you require 5-6 crores to retire. Today, if your lifestyle is 1 lakh rupees, you require 3.5 lakh rupees, 15 years from now. Most of us are clueless about this. Why? Because, they don't plan. They don't think about the future. That's the reason there is a saying, proper prior planning prevents poor performance. So financial planning will help basically meet their emergency requirements, will understand whether they're adequately covered or not, whether their income is secured, whether are they securing their beloveds, their spouse, their kids, whether all their aspirations like buying a car, second home, farmland, be whatever goal it is, traveling across the world. Today's Gen Z world wants to travel across the world. You need every year to plan to travel. For if you are planning every year to one destination, you might need from an Indian context 4-5 lakh rupees, 3-4 lakh rupees. So you have to plan and set aside that money. Be it a domestic travel. You are living in Germany. Schengen is 27 countries. To visit 27 countries also, you need euros. You need every year money. You need that currency to travel across. You need to plan. And that's what we do. We basically handhold you, and we'll ensure that all your dreams, aspirations are met with adequate money in the account. That's what financial planning is all about.
That's one thing. But however, see now, given that many people are using Zerodha and Trade, Toro, a lot of online apps now.
Very good question. Very beautiful.
Easy to invest there, right? So how even that is also kind of a financial planning, right?
Yeah, see, because when you go through a financial planner, you don't have the human emotional touch. See, today in India, 1 lakh SIPs have stopped. Why? Because there is no financial planner. People who have gone for online. People who have invested in online, there is no emotion there. There is basically, they saw a market going down, they have stopped. If I was a planner for them, I would have made them invest more. When markets are down, they need to invest, but everybody is stopping because in panic, markets are down, markets are crashing. There is a bloodbath. There is a lot of negativity spreading. Now, this is an opportunity to go and invest, not to stop your SIPs. Because average out, you understand the meaning of average out. When will you buy gold more? When it is highly priced or lowly priced? Today, 8,500 per gram. If it is 6,000, don't you think it's an opportunity? Will it not come back to 8,500? So it's opportunities when markets are low. So, but people miss that. Why? Because panic. The panic, they stop. The world is going to come to an end. That is how they will feel. COVID, what happened? Markets were 42, it came down to 25, 26. People stopped their investment. Trillions of dollars were lost. But in 6 months, market recovered. Whoever invested in the COVID are multi, lakpatis and crorpatis today.
Yeah, so, true. That's all the forecasting and then foreseeing, and then sometimes they call it luck, sometimes they call it missed opportunity. Yeah, that's how it is. Yeah.
We cannot time the market, Riaz. The time in the market is more important. You have to buy at all levels. You have to buy at low. Why SIP is an eighth wonder of the world? Because when markets are low, you buy. It averages out. Systematic investment plan is a blessing in disguise. So why we always recommend people to invest every month is because it averages out. Even when the market falls, you buy more units. When markets go up, you make money. Understand this simple logic. If it goes down, you buy more units. If it goes up, you make money.
Good. So Uma, are there any other further questions from the members?
Venkata Krishna, sir, you're able to unmute, sir.
Riaz, you can give them opportunity to unmute and also speak and ask questions if they want.
Dheeraj and Mahesh, it's trying to. Dheeraj, just unmute Mr. Venkata Krishna.
Dheeraj and Mahesh, please be alert.
Yeah. Yes, Mr. Venkata Krishna is unmuted. Please speak.
Yeah, could you hear me now?
Yes, you're clear.
Okay, thanks for the opportunity. Sunil, I heard your answer about investing in India and your thoughts about why India is a better market right now to invest and how the growth rate is going to be and stuff like that. I'm very much with you, and I'm also having thoughts to invest much more deeply into Indian market. That is my opinion, and I have no doubt about it. And it's there in the same thought process like what you're having. But what maybe the question was asked previously, but that has not been answered to the clarity level. I just wanted to stress or give this particular aspect to you so that you understand what the perspective in which the question had been asked previously, and then so that you can answer it. So
let's say have you put in the group, sir?
No, I did not put it, but the question has been asked orally by another person in the group, and you have answered it, but it is not to a full context. Let me just tell tell it once again. Suppose we invest in India and then we get a good returns, and then when we want to take back the money, the other participant has said when we want to enjoy the money and then get liquidated and then bring back to, let's say, Germany here. And in Germany, we are going to pay a tax of around 30% to, even when it is going to be more than 250,000 euros per year, then it is also going to be 42%, 45% based on the tax what we are going to pay from the foreign source income. So when we think of the long-term, the benefits that we are getting from investing in India, and then when we bring back to Germany, and then we are losing out on just the income tax part. And my concrete question here is, let's say I invest right now and after 30 years and then I bring back the money to Germany, and what is the best way I reduce paying the income tax, let's say not by 40% or something, maybe 10% or something, and then I enjoy the more benefit being in India during my retirement age? Because many of the people would have thought India is a good market, but for retirement they have their own personal choice. Let's say my personal choice is to retire in Germany and be in Germany, but I want money which I have invested in India to come back to Germany. What is the best way to reduce the taxation that I pay to the Germany to bring back the money from India to Germany?
Fantastic, sir. I think so. Akshay is here. He will take this question as a tax consultant, right? He has understood it very well. Over to you, Akshay, please.
Sorry to inform, Mr. Akshay is not there. Okay, I can just help you out. See, because as you rightly said, it's post 30 years. So again, it depends upon what are the tax slabs you are in. Okay, so that's why I would encourage you to directly get in touch with us so that, you know, we can guide you accordingly, because it all depends upon the tax slabs in India as well as the tax slabs in Germany, what that particular time when you bring out the money. Okay, so we can definitely connect one-on-one and provide you best information on this.
But for Venkat Krishna, see, we have Akshay's number here, who is a collaborative partner with us, 9886385161. So we have created a beautiful group. I mean, you know, definitely your question is of high importance. We will, you know, whatever your concerns are, your fears are, apprehensions are, we will definitely go all out in addressing it. And that's one of the reasons why Riaz brought this seminar today, or live, you know, chartered accountant, right? I really want to give you 100% clarity and total, you know, transparency in your question, what you're asking. Please take this Akshay number. If you leave the number in the chat box or in the group, we will definitely make sure that we have a one-to-one with you or a video call, right? And your question will be satisfactorily addressed. And, you know, I mean, only once you have that clarity that yes, why investing in India makes more sense, and how from a tax perspective or tax angle, how you can benefit more, then only you should come forward also, right? Is what at this point of time, you know. So since Akshay just left, you know, but definitely we will have a one-to-one separate call with you, Venkat.
Thank you. Thanks a lot.
Please fill the questionnaire, and as well as you can join our group. And I thank all the participants who have been joined the WhatsApp group. Almost 10+ members have already joined. Okay. And the question is, I request to be filled so that we can get in touch.
Venkat, please fill the questionnaire. 100% will give you a priority and come back to you, right? And we'll ensure that, you know, beyond this also, if you have any concerns and questions, that too will be addressed.
Any more last note? So yes, so I would like to thank all the participants who were joined in the sessions. Okay, it was great providing the appropriate informations to you all. Okay, and I also thank Mr. Akshay and Mr. Riaz and the all RMKS team, okay, who have been provided this opportunity to us. And again, Mr. Sunil Kumar, who has been provided the information. So if possible, I would request everyone to put in the chat, thank you for the entire team, you know, who have been gone ahead. So
yeah, special thanks to Riaz for organizing this from the RMKS Kannada Sangha, right? Really looking forward to work with you guys. We are a long-term player, being 20 years in the game, right? We are not here to sell something and, you know, go away. We are basically, it's a financial services industry, it's an handholding industry. We would love to really come back and serve. So thank you once again, Riaz, and the entire team of RMKS. Thank you, Riaz bhai.
Thank you very much, Sunil and the team. It was a wonderful session, and I think we need more of these to get educated on taxation, especially. I think that's a hot topic. And I see there were some messages also on the chat that the last question that Mr. Venkatesh asked was very valid for 90% of the audience. My suggestion, Sunil and team, would be to take a hypothetical example of a, say, 30-year-old living in Germany and experiencing his growth and retiring at 67 with the hypothetical numbers and assuming the tax slabs today. How does it look like? I think that would answer most of the queries. And then people might take their conscious decision of how to go
only
about.
will address this one in the group which
Yeah,
we
yeah,
have
better.
created.
I think that's good. Yeah, that would be great. Thank you very much again for the efforts.
Yeah,
And thanks to all the members who joined this session on a Sunday. Thank you.
Thank you.
Thanks all.